Hi everybody. In this video, we'll practice converting a few individual account balances from the cash basis to the accrual basis of accounting. And we need to know how to do this because sometimes accountants are called upon to convert cash basis financial statements to accrual basis financial statements, particularly for small businesses. Let's take an example. Suppose a company paid $20,000 cash for insurance during the fiscal year, and a little research, you determined that there was $5,000 of insurance prepaid at the beginning of the year, and at the end of the year there was a balance of $3,000 of prepaid insurance. You can determine the accrual basis insurance expense for the year with a little bit of a calculation. Beginning balance of prepaid insurance, which is an asset account, was $5,000. They paid an insurance premium during the year of $20,000. That brings the balance up to $25,000. But at the end of the year, $3,000 was still prepaid. So what do you need to make this calculation work? You need to reduce the prepaid insurance account by $22,000. Another way to look at this is that the prepaid insurance account decreased by $2,000. It was $5,000 at the beginning of the year, and it's $3,000 at the end of the year. So you can add that decrease in that current asset account to the cash actually paid to calculate the accrual basis insurance expense. Another way to look at the problem is by using a T account. Same facts. Just set up a T account for prepaid insurance and pop the numbers in. It's an asset account, so the beginning balance was a $5,000 debit balance. The ending balance was a $3,000 debit balance. And we know that $20,000 was paid for an insurance premium at some time during the year. That would have been a debit to the prepaid insurance account and a credit to cash. So what do you need to credit this account by to get it to balance? $5,000 plus $20,000 minus what equals $3,000? And its $22,000 credit is necessary. And that journal entry would be a debit to insurance expense and a credit to prepaid insurance. Therefore, the accrual basis insurance expense is $22,000. Can you tell what the cash basis insurance expense is? Why don't you pause this video for a moment and calculate the cash basis insurance expense. Then start the video again to check your work. The cash basis insurance expense is $20,000. Remember that on the cash basis, expenses are equal to the amount of cash paid for that expense during the accounting period. In this case, the cash paid for insurance was $20,000, so that is the cash basis insurance expense. As a matter of fact, under the cash basis, there is no such thing as a prepaid expense. So under the cash basis, there would be no beginning balance or ending balance in a prepaid insurance account, and the journal entry to record the $20,000 check paid for an insurance premium would be a debit to insurance expense and a credit to cash. Let's look at another example. Suppose a company paid $150,000 for salaries to employees during the year, and you determine, with a little research, that there was $12,000 of salaries payable at the beginning of the year and $18,000 in salaries payable at the end of the year. Determine the accrual basis salaries expense for the year. The calculation could be laid out like this. Salaries payable, a liability account, at the beginning of the year had a $12,000 balance. Cash was paid at some time during the year to employees for their salaries. So we would have to reduce the liability account by the $150,000, and we know we had an ending balance of $18,000. So what did we have to debit the account for to make this calculation work? Well, $12,000 plus $156,000 minus $150,000 equals $18,000. So given these three numbers, you can calculate the accrual basis salaries expense. But I really prefer looking at these things through T accounts. It's whatever works for you is okay. I happen to like T accounts, so let's set this up in a T account. Same circumstances, a T account for a liability called salaries payable, and a T account for an expense called salaries expense. We are given that we had a beginning balance of salaries payable, $12,000. It's a liability account with a normal credit balance, so that has to be a credit. We're also given that the ending balance in that account is $18,000 payable. We're also given the fact that at some time during the year, the company paid $150,000 in salaries to their employees, and that would have been a debit to salaries payable and a credit to cash. So what do we need in this T account to make these numbers work? Well, we need a $156,000 credit to salaries payable account to make it work. You can calculate this by working backwards. $18,000 plus $150,000 minus $12,000 equals $156,000, but then work it forward to prove that you're correct. Does a beginning credit balance of $12,000 plus $156,000 credit minus $150,000 debit equal a credit balance of $18,000? And yes, it does. So the accrual basis salaries expense is $156,000, and the accrual basis journal entry would be a debit to salaries expense and a credit to salaries payable. Can you tell what the cash basis salaries expense is? I bet you got it right. It was $150,000 cash basis salaries expense, because on the cash basis, the expense equals the amount of cash paid for that expense during the accounting period. As a matter of fact, on the cash basis, there would be no such liability account as salaries payable. And the journal entry to record the cash paid for salaries under the cash basis would be a debit to salaries expense $150,000 and a credit to cash $150,000. Let's work one more example. Using T accounts, assume that the amount of cash collected from customers during the year was $220,000. And you know that accounts receivable at the beginning of the year was $45,000 and at the end of the year was $33,000. If you set this up in a T account, what would the debit to accounts receivable have to be to make these numbers work? To get from a $45,000 balance and a $220,000 credit to the account to get to an ending balance of $33,000, you would have to debit the account by $208,000. And here's the calculation. $45,000 minus $220,000 minus the ending balance of $33,000 equals $208,000. Pop that in there as a debit and then work forward to prove that you got the right answer. Does $45,000 debit plus a $208,000 debit minus a $220,000 credit leave an ending debit balance of $33,000? And yes, it does. So the accrual basis sales revenue was $208,000. The cash basis sales revenue, of course, was $220,000. As a matter of fact, on the cash basis, there would be no such account as accounts receivable. There would be no beginning balance, there would be no ending balance on a cash basis set of books. And the journal entry when you received the cash collections from your customers would be a debit to cash and a credit to sales revenue. Well, that's all for this video. In the next video, we're going to do something really important. In the next video, we're going to practice converting cash basis net income to accrual basis. So I'll see you next time.